You're watching Personal Finance with Coach Kelvin. Let's get into the video.
Hey guys, Coach Kelvin here. Now today I want to talk to you about why it can be really important to allocate certain percentages of your portfolio to different asset classes instead of just dumping money without ever having an actual plan, okay? Now, I know for most of my videos, I really advocate about buying low-cost index funds for the majority of investors because you're going to get really good returns based on the performance of the entire index because of what you're buying. Generally, you're not losing a lot of your performance eaten up into fees. You're getting really good returns based on the performance of all of the companies that the index holds, and you're not reliant on one sector, one company, or one sort of asset class. So that's really important. A lot of these businesses have cash flow from product sales, royalties, real estate, etc. And every time that business earns money, it's returned to the shareholder, either through capital appreciation, through dividend payouts, share buybacks, and other methods that this can be done. So if you're someone like myself who has most of your investment funds placed into investment classes or asset classes like index funds, so for example, what I buy is Vanguard ETFs for the majority of my investments, it's really good to set an allocation percentage to other asset classes if you're interested in putting money into it and you understand it, but you don't want to have too much exposure or too much risk at hand. So for example, my asset allocation goals for cryptocurrency is between 1 to 2% of my portfolio. So during the recent market dip where the price of cryptocurrencies come right down, I kept dollar cost averaging in, and what's happened as a result, that my $50 per week that I invest into cryptocurrency has bought more of those cryptos than what it was buying previously when the market was more expensive. So now as we've seen that gentle recovery, what's really great is I'm getting a good return on the rebound. This has now put my cryptocurrency allocation to about 4%, meaning I don't need to really dollar cost average in because it's now exceeded my goal portfolio allocation. Therefore, I can take that $50 per week and place it back into my index funds or my other asset classes where my goal allocation is out of whack. I'm not going to stop doing that with crypto. $50 a week isn't too much loss, but I'm not going to add more to it if I feel like it's I've got the funds, because that's my underweighted asset class. So I'll put more money into my index funds, my peer-to-peer lending, etc. as I see fit. So what I like to think about is if you, for example, know that you want to have your safe or your base of your pyramid when it comes to investing in your low-cost index funds. So this bottom layer would be my index funds. The next layer would be my peer-to-peer lending and my other safer sort of assets like real estate. The next layer would be crypto, and then I might have some speculative stocks, okay? Now I do actually have two stocks that I've invested in which are speculative in my eyes. I've put money into them hoping for enormous upside, but I haven't put so much into them that it's taking on too much risk or the allocation would destroy me if it goes to zero, okay? So collectively, across my whole portfolio in these two speculative stocks, I only have about 2% total. Now, obviously, the rest is split between crypto, peer-to-peer lending, real estate, and shares, specifically ETFs. But I don't want to exceed my 2% allocation to speculative stocks either. So if I see that some of these start to have a really good run, my exit strategy is already in place, and I know that I have my goal of each of those shares reaching a particular target before I sell out. So for example, one of them I've bought in at around the 3 cent mark, and if that can ever exceed or reach $1, that's my exit plan. I want to sell out when I reach that goal. So I'd be looking at getting like a really good return for that to happen, obviously, and I'm not in any rush to sell it. I'm not desperate for the funds. If, however, the plan changes and I am desperate to retrieve some money and the investment has only doubled or tripled in that time, that's okay. I'm happy to sell out earlier than expected, but I know when it reaches this particular goal number that I want to pull my funds out at that point, okay? Now, when it comes to choosing which speculative stocks to buy, I still want you guys to do your own research, okay? So don't just listen to what your friends have to say at a barbecue or when you're having a drink and they're like, oh, you've got to get onto this mining stock or to this financial stock. still look into the balance sheet yourself, have a look, and make sure that you understand where your money is going. Because even a speculative business with the potential of good upside, that can still flop if the company has more debt than it has cash, it has no ability to raise capital, or it's over leveraged to the point where the short-term debts exceed its annual revenue, okay? If you can see that a company has, say, 20% of its revenue is going to be used to cover debts and it has no other expenses, then you know you're going to be cash flow positive. I mean, that's kind of cool, okay? But if you have a company where it's taking on debt just to continue regular operations and it's not getting any growth, putting your money into that becomes a huge problem, because you're essentially just throwing it straight down the drain. And I mean, in that case, you might as well buy a lotto ticket. So it's very important to do your own research on these companies. Now, there's obviously a lot of forums, like here in Australia, we have the small caps forum. If you're looking for a small, low market cap speculative stock, you could type it in on small caps, see if an article's been written up. You can do some research. You can look for Morningstar and other sources of information. But remember, when these analysts and people are looking into the business, they're obviously looking at it through their telescopic lens, and they're trying to find any problems that exist in the company or any upsides. When you are the consumer of a business, you can understand it at a different level, because some huge conglomerate sort of hedge fund is not going to consume products in the same way you do. So that may be your power, okay? If you're somebody who could identify in March last year that Afterpay was a really good business to put money into, you now would have seen your money almost go up 15x, okay? So that means it has doubled 15 times. It's quite amazing how much growth has occurred for it to go from $8 to $160 earlier this year, and now back down to $120. Had you bought Afterpay at $8 a share, you have done extremely well, and I don't think anybody would complain about those sorts of returns, okay? Now, as a consumer who doesn't earn a lot of money and who maybe utilizes a buy now, pay later service, you could see that this is really convenient for the consumer, for the shopper. The retail outlets are now getting more customers as a result. Yes, they lose some of the profit margin, but their brand and their business can grow, because more sales will occur when people don't have to front that cash straight off the bat. And this is your superpower as a regular Joe investor, okay? Because you are seeing things from the street eye level. You're not having to look into the company with a sort of fine-tooth brush or comb that hedge fund has to. So this means you can see what the companies that you're potentially shopping at, where you're spending your money or your time, what they're trying to achieve, without just being focused on the numbers. Now, whilst it is obviously important to know where you're putting your money and what the company is doing, I agree, your superpower as someone like myself is that you don't have to keep investors happy when you run your own hedge fund. Like when you run your own hedge fund, when you're an individual investor, you can have a paper loss for a few months and it doesn't actually matter, because if you buy with the intention to hold long term and there's a little bit of a loss in value of your initial investment, that doesn't mean the investment was a bad investment. Maybe the timing could have been better, but it still may be a wonderful investment, and you just need to hold off for longer before you then sell or divert your funds elsewhere. If, however, you are managing a hedge fund, often these people don't want to have a paper loss because they're trying to keep every investor happy. So if they're getting constant phone calls, hey, why has my investment dropped 10% in the last month? That freaks them out, and really they're just trying to service the customers and make them happy. So a lot more buying and selling occurs than really is necessary. And I would much rather be in control of my own money. So if I'm choosing to have, say, a 2% allocation to speculative investments, I absolutely am going to do that, but I at least get to control which speculative investments this money is going into. I can stomach a little bit of a loss because that's why I've only chosen 2% to do, or whichever percentage you decide. And it doesn't matter if I need to sit on that little paper loss for a year, 2 years, 3 years. Perhaps my timing was wrong, but if I still believe in that company and I hold, I could potentially see that upside come later down the track. So I think it's important to really heavily research where your money goes. Make sure you understand deep down in your heart that if you're putting money into a stock like this, don't just sell it for no reason. Only sell it when you reach your goal, or if you have an exit strategy or a new opportunity arises. I can't see any reason why you would want to just completely abandon ship, especially if it only went down a few percentage, unless you were desperate for that money. Like, let's say you had to replace your car all of a sudden, and yep, that investment had come down. You could take a $200 paper loss, or sorry, a 20% paper loss once you make that sale. But that will then carry over and offset any future capital gains. So, I mean, it can be utilized. It's not the most perfect strategy because, like Warren Buffett says, the first rule of investing is to not lose money. However, just understand that on occasion you may need to do that. But I would be more inclined to sell my investments which have had a return or are close to my exit strategy, as opposed to just selling everything for no reason. So when it comes to setting up your target portfolio, understand your percentages and how much money or what percentage you want to have in each asset class before you even make your first purchase. Because if I was somebody wanting to have a 50% exposure to crypto, but I couldn't handle the loss, I'm going to learn, or the volatility, I'm going to learn very fast that I need to change that asset allocation, okay? So what you're going to find very useful or very effective is to make a target portfolio with different allocations. You can watch what happens over a month, 2 months, and you can see, can I actually handle seeing my investment half or double overnight? Or is that too stressful? Okay, I'll reduce my exposure to speculative individual companies and cryptocurrencies, and I'll spend more money on real estate and index funds. Or if you love the thrill of the ride and you love the game of it, perhaps you do prefer the higher speculative risks with potential bigger upside, but also very fast crashes, which can be hard to stomach. So guys, I can't be somebody who recommends the right target allocation for different asset classes for you. Obviously, I'm not a financial advisor, and the only person that can choose the right allocation for you is you. So do your own research. Speak to people like a qualified financial advisor that could possibly help you with this situation, and let's keep trying to build that wealth over time. Now guys, if you got any value from this video, please like, share and subscribe, and I really look forward to seeing you in the next video.